Welcome to this explainer. Today, we're navigating what I like to call the tax labyrinth. We're going to uncover how the structure of your business literally dictates your entire financial reality. I'm so thrilled you're here because we're about to decode one of the most vital and honestly kind of complex aspects of building wealth and running a business. Whether you're a solo freelancer, building a massive startup, or just trying to figure out where your hard-earned money goes every April, the whole shebang fundamentally comes down to the entity you choose and the individual status you claim. So, I have to ask, are you making what is probably the most common, yet financially catastrophic senior level mistake in business? Talk to any tax pro and they'll tell you that applying the wrong entity tax model can completely derail your finances. It's incredibly common for folks to set up an entity without realizing the massive tax implications it carries for years to come. So let's make absolutely sure you aren't falling into that trap. Okay, here's our agenda for today. We're going to cover 1. The big entity decision. 2. Pass-throughs and self-employment. 3. C-corps and double taxation. 4. The nonprofit exception. And 5. Your individual filing status. Section 1. The big entity decision. This brilliantly illustrates the terrain we're covering. Choosing your structure is the ultimate fork in the road for any business. From sole proprietorships filing a Schedule C all the way over to C-corps on Form 1120, each path has a totally different set of rules. Your entity determines your tax classification, which dictates exactly how the IRS views every single dollar you make. Moving on to Section 2, Pass-throughs and Self-employment. Welcome to the pass-through paradise, where money flows straight through you. But, beware of the toll booth along the way. The crucial point here is that the business itself isn't paying federal income tax. It's basically a ghost to the IRS. Instead, the income flows directly through and you pay the tax on your share of the profits at your own individual marginal rates. It's highly efficient for sure, but it comes with a pretty massive caveat. And here is that warning label. If you're a sole proprietor or a partner, you're subject to a heavy 15.3% self-employment tax. That's a 12.4% slice for Social Security and 2.9% for Medicare. And remember, this hits in addition to your regular income tax. Since you're both the employer and the employee, you carry the whole burden. If you've got $150,000 of net business income, you're looking at paying over $21,000 just in self-employment tax. Ouch, right? Well, actually, there is a ceiling to part of this. The Social Security portion caps out at a wage base of $168,600 for 2024. Once your net earnings cross that threshold, you stop paying that 12.4%. But don't celebrate just yet. That 2.9% Medicare piece, no cap at all. In fact, if you're a high earner, crossing $200,000 single or $250,000 joint, you actually get hit with an extra 0.9% Medicare surtax. So to manage those heavy taxes, a lot of folks elect S-corp status. But what's really interesting here is the IRS demands extreme precision for this perk. You can have a maximum of 100 shareholders, they all must be U.S. citizens or residents, and you can only have one class of stock. Break just one of these strict rules, you'll accidentally destroy your S-corp status overnight. It's a real game changer, but you've got to play perfectly by the rules. All right, Section 3, C-corps and double taxation. Let's explore the alternate path of the C corporation, heavily known for the concept of double taxation. This sharply contrasts with our pass-throughs. Pass-throughs tax the income once. The C corporation structure, on the other hand, guarantees the exact same stream of income gets taxed twice. Let's see how this double hit actually builds. Step 1, the corporation pays a flat 21% federal income tax on its profits. Then, Step 2, when those after-tax profits are handed out as dividends, the shareholders get taxed again. Depending on your income, you'll pay 0, 15, or 20% on those qualified dividends. Tax at the company level, tax at the personal level, double taxation. But lower your voice and listen closely. Double taxation isn't strictly a trap. As they say, for businesses that will reinvest profits, the flat 21% C Corp rate may be advantageous. If your strategy is to keep the money inside the business to fuel growth, you aren't paying out dividends, so you only get hit with that flat 21% rate. Compared to a high earner paying 37% personally, that 21% rate can be an incredibly powerful tool. Section 4, the nonprofit exception. A lot of people think nonprofits literally never pay taxes. Not true. While mission-related income is tax-free, beware of UBIT, or unrelated business income tax. If a charity runs a commercial side hustle like selling advertising space, that can suddenly trigger regular corporate taxes. The IRS just wants to make sure they aren't unfairly competing with regular for-profit businesses. Okay, Section 5, your individual filing status. Eventually, all of these complex business choices flow downstream and land on your baseline, your individual filing status. This dictates your tax brackets and deduction sizes, and it is permanently locked in based on your marital status exactly on December 31st of the tax year. So, if you get married at 11:59 p.m. on New Year's Eve, the IRS considers you married for that entire year. How romantic, right? Think of your standard deduction as your baseline tax shield. For 2024, if you're single or married filing separately, that deduction is $14,600. Just a quick aside, filing separately is rarely optimal because it triggers all sorts of limitations, but that's your starting number. Now, if you are married filing jointly, or you're a qualifying surviving spouse within 2 years of your partner's passing, that standard deduction literally doubles to $29,200. And sitting perfectly right there in the middle is the head of household status, providing a $21,900 standard deduction. This is an absolutely essential tax shield if you're unmarried but paying more than half the cost of maintaining a home for a qualifying dependent. So, what does this all mean? We've navigated from the big entity decision all the way down to how it lands on your personal tax return. Now that you understand how money flows through this labyrinth, take a hard look at your own setup. Is your hard-earned money flowing through the most efficient structure possible? Or is it time to chart a smarter path? Thanks for joining me on this explainer, and keep exploring.